First and most obviously, when the Fed raises US interest rates, they tend to raise interest rates all throughout the world just because the United States is such a large economy, because the dollar is so dominant in global financial markets, and especially for emerging markets because a lot of emerging markets borrow a lot of their funds in dollars. So, for starters, when US interest rates and global interest rates go up, then emerging market economies have to pay more in debt service. And if some of these economies are vulnerable, if they have very high debt levels already and very high debt service levels already, then it can be very costly to them to pay extra interest. So that's channel number one. Channel number two is that when the Fed raises rates, that tends to raise the value of the dollar in financial in exchange foreign exchange markets relative to other currencies. So for an emerging market government that has borrowed in dollars and now, because of the higher interest rates, sees the dollar rise in value, that means that in local currency it's now more expensive to repay their dollar debts. So that's the second important channel. And then finally, when the Fed raises interest rates, that tends to attract capital from the rest of the world into the United States. And again, that kind of like that reversal of capital flows that had been going to emerging markets can be very destructive.